Good morning, everyone, and welcome to Morning Notes. I'm A.F. Thornton, the Chief Investment Officer of BluPrint Quantitative Strategies. So I don't want to waste a lot of time. We only have about 15 minutes, so let's get into it. As always, we have to put up the risk disclosure, make sure that you realize that these sessions are for educational purposes only. We're not telling you what to do or how to trade, nor should we. You always want to rely on a financial advisor for that knows your personal situation. So use this simply as educational information that we're sharing with you that hopefully helps you make better decisions. Of course, if you like this content, please hit the like button below and consider subscribing to this channel and hit the notification button so you're aware of our future videos. We do the morning notes every morning before the open just to give everybody at least our insight into where we're headed for the day and week. Last night we did our Sunday night forum, and for some reason the video just didn't turn out. So we ended up having to delete it. Hopefully those bugs are worked out this morning. So we'll cover a little bit of that ground this morning as well, just so we can get it up in a recording. So basically, the question this morning is, where are we and how far can this rally take us? And I would suggest to you that we just completed the first leg down in the bear market, which is a leading diagonal. We typically see leading diagonals in 1 and 5 waves and also C waves. So when we see a leading diagonal here, much like we did in the 2008, 2009 bear, it usually means it's a first leg down. Obviously nothing's written in stone, but do keep that in mind. So looking at the day and the week ahead, let's just cover the ground quickly here. As I said, the first leg, or a 1 down, is complete. It was a leading diagonal, just like the start of the 2008-2000 bear. So we're in our first retracement rally. Maybe in Elliott parlance, it's a 2-wave. We're likely to retrace 50 to 61.8% of the January to June decline. And I know that's hard to believe right now, but that's typically what we see. That's also what we saw in the last 2 bear markets. So do not be surprised. Now, at the moment, I can only see us getting up to 4,000, but we'll see how that develops. Now, again, this is a strong bear. We might not make it that far, but those are at least my initial targets for this 2-wave. Be sure to look at and follow our current market thesis, which is in the blog section of our website at BluPrintQuantitative.com. And don't forget to drop the E from BluPrint. For now, the retracement rally is aligning with the seasonally strong summer rally period that we typically see this time of year. And this week, our weekly expected move sandbox, I like to call it my playground, is about 200 points from 38.15 to 40.15. And the expected move for today, that sandbox, is about 38.50 to 39.75. So to keep my charts uncluttered, all I'm interested in for this week and today is any kind of key level or moving average or something that's going to appear in that limited range or windshield. Now, nothing is written in stone. These expected moves only occur and are accurate about 70% of the time, which is pretty good odds, actually. But we have seen the last 4 out of the last 5 weeks, we've been getting 2 sigma moves, and these levels, which come from the option market, showing us that the options market is not very well priced right now, but hopefully they'll get it right this week. In addition, our proprietary navigator algorithm gave us a new buy signal on the daily chart at last Thursday's close, or about 38.8875. The short-term trend in context is up. For the most part, we want to be looking for long trades this week on pullbacks as long as the rally prevails. But remember, we're still in a bear market in the intermediate trend and trading right on the volatility trigger at 39.05. Below the volatility trigger, dealers still must sell into declines and buy into rallies, exaggerating and lengthening the moves in both directions. Above 39.05, though, dealers will sell rallies and buy declines, more logical, and that helps reduce volatility and leads to more mean reversion type of price behavior. Now, looking at the key levels and issues today, the key inflection point today and for the rest of the week is this super high volume node on the daily chart at 39.10 to 39.20. I mean, it's a huge volume node, including all volume traded at those price levels over the last, over time actually, because we haven't been up there that long. It's a significant hurdle to conquer whenever you see these nodes, regardless of the direction you're coming from. And in our case, there are significant air pockets both above and below the node, which would allow the market to move very quickly through those ranges. So how the market handles this high volume node is going to tell us a lot. And of course, coincidentally, the 21-day line mean at 39.03 is close to the super high volume node, as is last week and Friday's high at 39.20. It would be short-term bullish if the market could stay above these levels and we could look to them at least as short-term support. But the opposite is also true. If the rally is going to fail early, this is the level to push it back down. You got the 21, you've got this high volume node, and you've got last week and last Friday's high. Now, overnight traders seem to have helped the bullish case already, testing 38.95, but later besting Friday's high, which is bullish, and trading as high as 39.48 overnight. As a result, the S&P 500 could open with a true gap higher, and if so, gap rules are on the table. You can go over to our website, again, BluPrintQuantitative.com, and go to the glossary and see what those gap rules are. Now, if last week's rally fails here, the relatively minor support in the air pocket below us is Friday's POC at 38.90. Its midpoint at 38.75, the 5-day line at 38.56, which is also the low volume node of the air pocket, and Friday's breakup candle low at 38.31, and then, of course, the weekly expected move low at 38.15. Though ostensibly outside this week's range, the air pocket ends at 37.61, and the next super high volume node on the daily chart is 36.88. My best judgment is the market is more likely than not to use the bullish seasonal bias together with the tailwinds associated with month and quarter end to push up to the WM high this week at 40.15. That's my best guess. And of course, in addition, you always want to look at the roundies and half roundies on the 100 scale, but the S&P will encounter resistance if we do go north at the bottom of the gap around 39.60, and then there's a downtrend supply line from March that comes in around 39.95, and that also tracks pretty close to the falling 50-day line. And depending on how the week goes, that is about all that I see between here and 40.15. So, we could move through these air pockets. The market tends to fly through them because there's no poorly located longs or shorts in those gap areas. As far as red letter reports and caution today, again, we're still in a bear market until proven otherwise. Don't hold any opinion too tightly. Don't forget that there are exogenous events all over the world that could rear up at any moment. Do not trade without stops. We have durable goods coming out pre-market and existing home sales about a half hour after the market opens. And there are some European central bank speakers later today, but otherwise today looks fairly quiet. But do recall that Friday's existing home sales report threw the market for a loop as it was a lot higher than we expected. In fact, I was about to short a rising wedge when the report came out. Thank God I didn't. I don't know if I could have even gotten my stop in before the market ripped higher. So be careful. This existing sales report might surprise us as well. And of course, Friday was a big range expansion day, and with the air pocket, with the air pocket today could follow suit. And the street's been pretty short lately, and money manager FOMO leading into the end of the quarter and also options expiration on Wednesday could provide some tailwinds, although I do see a lot of options filling in and more put buying on Friday into the rally. So it's getting harder to see the market moving much above 4,000, but we'll see how it goes. Usually after you have a large expansion day like Friday, today would probably be see some more contraction, maybe consolidation, more balanced trading. We'll see. Again, these air pockets above and below us really complicate things. Generally, while I get all the information I need to know from the S&P 500 price action itself, keep an eye on junk bonds. Pull up the HYG or GNK. They can be a good leading indicator. They certainly led us into this bottom, but they're still weak. And if we saw new lows on the hourly chart in junk bonds, I would definitely start to get more bearish. And of course, there's a lot of problems going on in the crypto world. It's on thin ice. It could cause a market dislocation and contagion in a meltdown. So just keep your eye over there. As far as today's approach, first thing I'm asking myself today is who's off sides, and the shorts are still suffering from Friday. Always keep that in your mind and throughout the day. Always ask yourself who's off sides, because that's going to give you some good information. I'll be trading inside out from a 2-minute chart. I'll use a 15-minute chart as my anchor. I'm generally looking for long trades as long as the 15-minute algo is in a buy signal and in agreement with last Thursday's daily algo buy signal. I'm also using a 20-day cumulative volume profile to look for support and resistance. I mean, these all relate to each other fractally and are generally the tools that I'm going to use. Sorry, I'm moving my mouse around here. Initially, I'm going to follow gap rules if we do get an opening gap, and it needs to be a true gap, meaning we're opening higher than Friday's high, not just where it closed. After that, I'll look for an opening range trade off the first 30-minute bar. I look for a breakout, and I target either half the range or the full range where I'm going to take profits. After that, I'm just looking for market structure to allow me to lead against something to go long as I have enough distance to my target to justify the risk that I'm taking in the trade. I usually trade 2 contracts, using the first to get risk out of the trade, move my stop up to break even, and then hold the second to the target. So whatever I'm targeting, it's got to have enough distance to allow me to accomplish all that. In addition to all the key sandbox levels we've been talking about, and as I am coming from below, my targets include the overnight high, midpoint, VPOC, and low, Friday's high, VPOC, midpoint, and low, last week's high, midpoint, and low, the initial balance, first hour high and low, the developing VPOC, value area high and value area low, and any resting or high liquidity that I might see in the book. I use auction theory to keep track of and trade the high volume nodes as they change throughout the day. High volume nodes are just hurdles to conquer. As with any key level, I'm looking at how the market reacts to that level. Is the market pushing away? Is it able to push you after running the stops? It's the usual stuff. And I'm watching that volume on the volume profile. Is volume drying up? Is it increasing? Is there acceptance? These are all things that can help you not only find a key level to trade from, but also a good target to see if the market is weakening. I'm always looking left for market structure and related stops. And of course, often the limit orders that you see in the book will coincide with all of these aforementioned key levels. So summarizing the day ahead, again, I do think the first leg down into bear is complete. It's a leading diagonal, which, along with a lot of other things, causes me to believe that there's more declines ahead. But hey, let's take the summer rally, even if it's short. Let's see where it takes us. And probably we'll start another down leg after this is complete that will take us into the usual September, October week time frame in the fall. I do think if the 2000 to 2003 or the 2007, 8 to 2009 bear is analogous, this is about the point where we turned up. And in both cases, we recovered about half of what we lost before we started what we call the third down leg, where the damage really got done. So again, look at our blog. There's a lot of good information in there, BluPrintQuantitative.com. Always remember to drop the E from BluPrint. The current market thesis and a complete analysis of the big picture are always there and available to the public. This retracement rally, like I said, is aligning with a seasonally strong summer rally period. We know what our sandbox is for today and for the week. We're in a daily buy signal, which we haven't seen for some time. And again, that's just causing me to look for long trades this week. I always like to trade in the direction of the prevailing trend. I'm not much of a contra trend trader. I mean, if the market is perfectly balanced, I might take some shorts, but you know, the shorts have been ruling now for quite a few weeks. So I think we're just at that point now where we can take some long trades. Of course, we are still in a bear market. And like I pointed out, we're right around that volatility trigger at 39.05. So whichever way we take this, if we can go up, it will cause the volatility to contract. We'll see more mean reversion type of behavior. And again, like I said, I can see clearly to 4,000, but that's about it. Now, to put it bluntly, I guess I was going to say, I'm a mean reversion trader and stop hunter. With a shout out to Tom B over at Bookmap, who always says, think like a retail trader, but don't act like one. Ask yourself throughout the day, where are the retail stops? Institutional traders don't use stops. Stops are an instrument of the retail crowd. Generally, you want to trade into their stops and take your profit. So when I'm looking at a key level, the reason I'm looking at that level is because I know the retail traders have their stops up there. So if I can get positioned to travel to that level, in this case long, then what I want to do is use the market structure to get positioned. I'm going to ride that trade into those retail stops and get out. I might hold a runner depending on how many contracts I'm doing, but that's the basic objective. Typically, if you trade against the retail crowd, you'll make a lot more money. If you want to learn more, trade with me on Tuesdays and Thursdays, go to BluPrintQuantitative.com and sign up for our trading room under the active trader subscription in our services section of the website. Explore the blog post, and don't forget we dropped the E from BluPrint. Again, if you like this content, be sure to hit the like button below. Subscribe to the channel. Consider subscribing. We're just starting out, and we want to build a great community here. And also hit the notification button if you want to be notified of future videos. Again, thanks for joining me. Have a great trading day, and I'll be back tomorrow.